Okay, today on the Income Flip podcast, I have Earl Yaokasin from Pasadena, California. Earl, welcome.
Thank you, Rob.
So, we're going to talk a little bit about building wealth today, right?
Yeah.
But before we jump into that, I always love to explore the journey of the entrepreneur because you yourself, even though you're a CFA, you yourself are also an entrepreneur. You're a business owner.
Yeah.
And so let's unpack that a little bit. When did you decide that this was going to be the right thing for you to do to bet on yourself?
Yeah. So let me tell you a brief timeline of my journey. There are really two parts to it. And so the first part was when I was younger. It's all about dreaming big and saving as much money as possible. And so as early as first grade, I would go around my school. I would look for Coca-Cola bottles and turn them in for a recycling credit at our local canteen. And every bottle I would get like 50 pesos because that was in the Philippines. 50 cents in pesos. Mm-hmm. And I would need about 5 to 10 of those to get a yummy, delicious barbecue pork skewer. Have you ever had one of those?
Oh, yeah, delicious.
Okay, yeah,
Love
yeah, yummy. And then later on in second grade, I would sell all sorts of snappable bracelets from different colors, different designs. Then as I grew older, I would sell CDs, even fireworks, concert tickets, cell phones. So I would sell various different things just to make an extra buck. And one day I turned on the CNBC channel and I saw these things going up and down. And I knew instantly that I could be good at it because I was good at math. I won a national mathematical competition in 7th grade. And also I loved games. And so when I saw a stock chart going up and down, I thought, this is a game. I know I can be good at this. And so I did everything I could, save as much money as I can to go to the US. So this is kind of the second part. So the second part, I continued to save, but it's all about, and continue to dream big, but it's all about sacrifice, working hard, and investing well. So when I got to the US, I had to start working for a Nordstrom factory doing data entry at minimum wage. So this is even though I graduated from the best, arguably the best business school in the Philippines, graduated on the dean's list on my senior year. All of that had no bearing. I had to start from the bottom. And you can imagine doing data entry is as boring as hell. And I made it like a game. And so every day I would try to beat my record of the previous day. And within a week, everybody was saying, who's this young dude beating 10 years, people 10 years on the job? So that was interesting. But of course, minimum wage wasn't enough to make, ends meet for myself. So I moved on to a different job in a real estate appraisal company called PCV Mercer here in Pomona, California. Have you heard of them? Maybe. Okay. So yeah. So they're here in Pomona, California, and I got a slight bump up in my salary to $10 from minimum wage, and still that wasn't enough. So I had to work a second job at Bank of America Investments. If any of your audience is familiar with Southern California at all, I lived in Rancho Cucamonga. I drove to Pomona, which is about 30 minutes away from Rancho Cucamonga, if no traffic, and then another 30 minutes to Pasadena, almost every single day. And you can imagine working two jobs, having that long commute. It was extremely, extremely exhausting. But I would just continue pushing through, because I had a dream. And my dream was to someday start my own company. Eventually, after that stint, after about a year and a half, I was able to land a job at American Express Financial Advisors, which is now Ameriprise. At that time, I had a rude awakening. My rude awakening was that most financial advisors are just salespeople. There is almost no training on how to invest your client's money well. All they want is for you to sell so that you get a commission and the company makes a commission.
Earl, yeah,
And
when you said
yeah.
when you said that you started at American Express Financial, I know that profile from back in the day. I used to recruit
Oh,
salespeople, right?
okay.
And I was like, that's hardcore. They give you like a telephone and they're like, go make it happen, right?
Yeah, yeah, telephone and a script and figure it out.
Figure it out.
That's your training.
Wow.
So yeah,
Wow.
so that was a bit disheartening, because really my focus was trying to become a portfolio manager and really become a great investor. Eventually, I moved on to Bank of America Investments, which is now Merrill Lynch. So at that time, I supported the top two financial advisors in the Inland Empire region.
Mm.
And after maybe a year, they noticed that my stock picking skills or my expertise in stocks could be used for their clients. And they started trusting me in making decisions for the stock portion of the portfolio for clients instead of the in-house department that actually does it. And when I was there, our clients, in terms of the stock portion, did better than the in-house department. Then I started studying for the CFA designation. I moved to the Capital Group in 2007, which at that time was about the third or fourth largest investment firm in the world, behind Vanguard and Fidelity and maybe BlackRock. So at the Capital Group, I carved my way into a unique role where I would have access to all the portfolio managers and analysts, listen to every call, read all the reports, translate that to the operations team. So, for example, if there was $100 million contribution by some institutional account, they would use my notes to help figure out what to buy and sell for that $100 million deposit. So I did that, and I learned so much. And I still also manage my own portfolio and also created my model portfolio as well. And my model portfolio outperformed all of the portfolio managers and analysts that I worked with. So in 2014, I decided to start my own firm and help clients invest the same way that I do.
Hmm. Hmm. Well, let me take a step back.
Sure.
You were working for a large organization, so there was a
Yeah.
lot of security in working for
Yes.
a large organization,
Yeah.
and you started proving to yourself that you had what it takes in order to perform better than the big boys.
Yes.
And so you decided to bet on yourself. Like, how,
That's correct.
you bet on yourself. Were you married? Did you have kids? Like, tell me a little bit about what was happening in your personal life when you decided to do that.
Yes, I was. So that was 2014. I was married. I had two kids. My oldest daughter was 5. My youngest daughter was 2.
Wow.
And being an entrepreneur, one of the most important things that I stress to younger entrepreneurs is to minimize risk. And how do you do that? So I mentioned during the first part of my life, I would continuously save money from selling various things. I would get these red envelopes from Chinese red envelopes from my uncles, aunts during Christmas and birthdays. I'd save all of those.
Hmm.
And when I was working really hard, driving that long commute, my meal for the day was a $5 footlong, half during lunch, half during dinner. So really just living like a caveman for like the longest time. And aside from investing well along the way, what that allowed me to do was build a nest egg. And that nest egg lowered the risk when I decided to take the leap into starting my own business, because even if I had 0 clients for a while, I can live on.
Yeah, Earl, I'm not quite sure what's happening with my camera. It just literally is just turning off. Hang
No
on.
problem.
We'll keep it going because I'll just get
Sure.
the editor to do it.
Okay.
How disappointing. This might have something to do. The good news is is this, Earl. Like, we're gonna have to edit this one a couple because I know I butchered your name in the beginning, and
Yeah,
we're gonna fix that.
no worries.
But it's odd. It's almost like the power is going out. So it might happen to us a couple times. I'll
No
just reboot
problem.
it and we'll edit
Yeah,
it. Okay.
yeah, no problem at all.
Okay.
Do I just go
Yeah. Just
from
keep
the
going.
last sentence? Okay.
Yeah.
So I was able to build a nest egg, and that nest egg allowed me to survive even if hypothetically I had zero clients for 10 years. And that gave me the confidence to take the leap. The other thing I did to minimize risk was to line up potential clients even before I started. Now, officially, I can't manage their money while I was working at the Capital Group, but I was just asking for levels of interest and just making sure that every year I was actually planning it for a long time. So this is not like a snap decision or something. I was planning this for years, for at least 5 years while I was at the Capital Group. And every year I would try to get a pipeline of people saying that, okay, if I leave, will you invest with me? And so that was the other risk mitigation tool. And I waited for a very long time because I was building my pension account at the Capital Group. I was waiting for it to fully vest. And once it fully vested, I know, and I had that big buffer that I could just simply take the leap without much fear at all.
Now, were you worried about touching the principle of that, right? Meaning, when I think about it, at first I was thinking that you were really saving something like 6 months or a year or 2 years of reserves in a checking or money market account. But it sounds like you were just building your overall pile, right? And that you were going to draw from that. Is that correct in that assessment?
Yeah, that's definitely correct. But I've been saving since I was a kid, really, and so it was decades of saving and compounding that with good investments. So I had a good nest egg, and definitely I was going to be taking money out of that nest egg. But at the same time, I was also invested in the stock market. And every year, as you know, more or less, the stock market would continue moving higher. So I thankfully, did not really dip into the principal that much, except for the first year. There's so much startup costs.
Sure.
But beyond that, I never dipped into the principal because the investment income that I earned was a lot more than the expenses that I needed to pay up.
Okay. So in the language that I use within my organization, we typically talk about creating a cash machine so that you can create a wealth machine. Meaning, as sales agents or investors, we're getting paid, right, to do deals. But over time, you've got to transfer that money, whether it's into savings, buying stocks, building a business, real estate, so that money starts working harder than you do, right? So that it is, essentially creating the income flip. So it sounds like you decided to take the leap when you had a full-fledged wealth machine already working for you, right?
Yes.
That's fantastic. That is fantastic. And what I'm hearing for those that are listening right now is that he learned how to control a dollar early, right? That's what's a lot of times saving and directing the dollar. So why don't we talk a little bit about that, the psychology of directing your money? Because I'm sure that this is a lot of what you're helping your clients fully understand, right? Spend less than you make. Let's not be emotional about it. Help me understand how you developed that. Like, was that come from family? Was that just innate in you? And then also how you think about it, right?
Yeah. So just like most studies have shown, there are two main factors of why someone becomes who they are. One is innate and one is upbringing. And innately, I was just a saver in general. Aside from asking video games from my parents, buy me this new Nintendo, game. Other than that, I don't spend money on clothes. I don't really go out that much compared to other people. So I really just saved a lot by itself. Additionally, when I was growing up, my mom would always repeatedly tell me, live 2 levels below your means. And like a broken record, which is both a good and a bad thing, as you can, as you might
Yeah.
imagine. But that definitely stuck with me all throughout my years. And but I do feel that even though she wouldn't say that, I still think I'd be extremely frugal to this day because I think that's just who I am.
So how do you? So that's interesting. Are you from an avatar perspective, meaning your ideal client, right? Those listening in, your ideal client. Do you find that that same personality is attracted to you, or are you coaching them on this superpower that you have as they are continuing to build their wealth, right? So let's talk a little bit about your ideal client,
Yeah.
and then how you guide them through this whole process.
Sure. So my ideal client is someone who has $500,000 or more to invest in the stock market. And I do find that a lot of my clients have a similar personality to me where they're not flashy. They're they're fairly down to earth people. And
That's okay. Keep going.
oh, okay. And if you have read the book The Millionaire Next Door, there are so many wealthy people who go into Costco with maybe just a normal T-shirt and sometimes even with a rip on their on a part of their shirt, So that's the kind of people that I find who are attracted to me more than people who are flashy, who are driving Lamborghinis or things like that. I think like attracts like.
Okay, let's pause there for a second,
Sure.
and let me see. Hang on one second. I think I might know what's going on. Okay, we're just gonna switch cameras.
Sure. No problem.
Yep. That way we'll just keep rolling. Okay. So, like attracts like, is what
Yep.
you were saying.
Yes.
Okay. And so I read something on your website that I think was important. You said, I don't like hardcore sales. I don't like sales tactics, right? Which is, ironic that you started your career with American Express Financial. but you probably early on learned, hey, this is what I like, and this is what I don't like, right? And so, tell me a little bit about how you've over the years generated your client pool. Has it been through word of mouth? Has it been through trainings? I'm just curious more than anything.
Yeah. So there are two main sources of how I generate new clients. One, as you mentioned, it's word of mouth, referrals. And then the second one is if any of your audience would Google my company, Wealth Arch Investment Services, you can see 100% positive 5-star feedback on Yelp and on Google as well. So those have generated some good new prospects, which some of whom have become clients.
Yeah, I would imagine through the years as building any business, you're going to attract like kind, but also if you do a good job for them, this just becomes a referral machine for you, right? It
Yeah.
just becomes where your clients are going to start referring you. And I want people to hear that, because this is running any kind of business is like that. Now, one of the things that you and I talked about, Earl, was some of your core key concepts that are both applicable when it comes to the stock market and investing in real estate. And I'd love to explore some of that.
Yes. So I have several of them. One of the most important principles that I think both stocks and real estate share is that you want to keep turning over rocks, right? So you're not going to buy the first stock you see. You're not going to buy the first property you see. You're going to have to look at so many different ones to get an idea what is a bargain and what's not a bargain. So that's principle number one. Principle number two would be you need to evaluate both the risks and the rewards. There are some investors who just focus on rewards, how much can I make, but there are surprises, right? So in real estate, suddenly you need to repair the roof or you need to repair the plumbing. In stocks, suddenly this product didn't work out as you thought. So you need to look at both risks and rewards. And in order to reduce your risk, what you want to do is to create a buffer. And in stocks, we call that kind of like a margin of safety. So in other words, if you were looking to buy a $1 million home, let's say, and you think you can sell it for $1.5 million, your buffer is $500,000. Let's say you're wrong about the neighborhood, then that reduces your future sales price from 1.5 to 1.4. Let's say surprises happen and you're the expert, Rob, but I'm just going to make round numbers so that it's easy for your audience to follow, right? So let's say you need to spend $100,000 for the roof and the plumbing, right? So then your future sales price goes down to 1.3. And then let's just say that obviously there are still some, it takes you longer to rent out the property, incurs you additional costs, some closing costs, mortgage costs, fixer-upper things you didn't expect. So take out another 100,000. So then your sales price goes to 1.2. But because you had that big buffer, you are still going to make a profit. It's the same way with stocks. If I find a stock is worth $100 and it's trading for 50, that's a good bargain. Mm-hmm. So these three things are, quite important. I could go on for. I have a few more principles if you'd like me to proceed.
Yes, please share.
Okay.
Yes.
Principle number 4 would be having a longer term horizon. So in real estate, if you do a short-term flip, there are higher costs to do so. You're going to have costs on when you purchase the property and when you sell the property. If you lengthen out your time horizon by a little bit, you're spreading the costs over several years and allowing the property to appreciate more. And at the same time, if you're renting it out, you're getting rental income. So you are stacking the odds in your favor if you are not pressured to sell it within a few months. Mm-hmm. Same thing goes with stocks. In stocks, there's a study done before 2008. If you have a 1-year holding period, on average, you would make 56%. You'd be positive 56% of the time. If you have a 3-year holding period, you'd be positive 2/3 of the time. 5-year holding period, 75% of the time. And then 10-year period, 90%. 20-year period, 100%. So what does that mean? Even if you purchase at the top of the bubble, if you have a holding period of 20 years, you are going to make money, historically speaking. Mm-hmm. So that's principle number 4. Principle number 5 is to continuously evaluate and improve yourself. With every transaction you do for a real estate or a stock, there's always something you could have done better. And if you did it perfectly, realize what were the good things that I've done, what were the positive characteristics of this property that I saw, and then maybe I can repeat that going forward, right? And then principle number 6 is to make sure you're looking at the total return. So some investors who are newbies, right, when they invest in an income property, they don't allot for vacancy expense, taxes, so on and so forth, maintenance, etc. Vacancy. In stocks, there's some people, they only focus on the dividends. That's their strategy. But this is the biggest misconception in investing in stocks, and I teach financial advisors this, is that if you take a normal stock and they pay out a dividend the next day, the stock drops by the same amount, all else equal. So as an example, if some stock was trading at $100 and they paid out $1 dividend tomorrow, all else equal, the stock will open at 99. So nothing has changed, right? But actually, the difference is that you're actually taxed on the dividend when it's issued. So some people, they just focus on the income part, and it's not really income because again you're taxed on it, and the price of the stock goes down. But you should focus on the total return for stock. So I would say those are the 6 really important principles that both stocks and real estate investors can learn from.
Yeah, I love that. Looking at the total return, because oftentimes I've seen that mistake happen with a lot of our investors on the real estate side, where they might just be looking at the cash on cash return, but they're not looking at the internal rate of return, right, of that particular asset. Now they might be basing their decision on, hey, I need this amount, I need an 8% cash on cash return, right? I'm like, great, but let's factor in also appreciation, the tax play, right? Can you actually depreciate that, do a cost seg study, right, and benefit from that? So you have to look at the total return, right?
Absolutely.
And in fact, it's funny that you should talk about the fix and flips, because my wife and I just did a little happy dance this morning. We celebrated the fact that one of our projects that wasn't going according to plan is back on track, right? And it's one where the asset value is $700 fixed up. We bought it for $300, but it needed a $350, but it needed, $200,000 worth of work. And when it needs that much work, there's inevitably always going to be problems associated, right, that you weren't expecting. We hit one of those. There was one of those problems that we hit, and we're over that hurdle. But that fix and flip, I don't really consider that investing. I just consider that really more active income that we're making. Once I convert that active income into a longer term asset, then at that point I'm considering that like investing, right?
Yeah.
What's the number one mistake that you see investors make when it comes to building wealth?
It is that investors normally like to follow what everyone else is doing. So if everyone's excited, they get excited and they buy the hottest stocks. If everyone's panicking, they panic and they just sell without question. And that is actually the cardinal sin of investing, which is selling when everyone panics. Because it is actually the best time to invest is when everyone panics, because that means everything is at a super bargain. And that's where the big money is made. Not when the stock is going up. That's not when the big money is made. It's when everyone's panicking. And as an example, if we go back to prior to the dot-com bubble, everyone was super excited, they were day trading, so on and so forth. And if you invested in the S&P 500 in 1999/2000, you would not have made money for 12 years. That is an extremely long time. If you invested in the best tech stock of the dot-com bubble, which arguably, could be Microsoft, could be Amazon, but Microsoft, if you invested in Microsoft, you would not have made money for about 14 to 15 years.
Wow.
That is an extremely long time. Amazon dropped almost like 90% after that. So the mistake was everybody was believing the hype. They're not questioning stuff, and they just bought. And then, if you remember the financial crisis, I was dragged by my relatives to various real estate seminars, and they were telling me, Earl, you have to buy real estate. It's such a good deal. Everybody's doing, nobody's going to lose, all that kind of stuff. And I actually took the opposite view. I was the one who was telling people that this is not going to last forever, and this is just nuts. Eventually, there's going to be a downturn. But of course, nobody listened to me. I was one of the few people, and I was working in the Capital Group. Early 2008, I put 100% of my 401k and my pension into cash because I could see the writing on the wall. Everybody was greedy. Everybody was super excited. And then when the market panicked, I did the opposite, and I went 100% stocks. And that's why I was able to build this nest egg from just saving throughout my life and able to start my own business, is doing the opposite of what people are doing. It's kind of like if you find a good deal in real estate, right? Like you bought this property for $350, $250, whatever. It was selling at a discount because nobody else wanted to buy it, right? And you could see that there was some inefficiency there that you can capitalize. It's the same thing. When people are panicking about a certain stock or a certain sector, there is some inefficiency there that someone can exploit. And I'm a shark, so I will exploit those inefficiencies.
Yeah, it's interesting. I had the privilege of being a young entrepreneur at 24 during the dot-com boom, right? So we started, we owned a recruiting firm, and I experienced what it felt like to go through irrational exuberance, right? Where we were getting paid large fees for people that weren't that good, right? But I didn't know any better at the time. And so we're investing alongside our clients like pet.com, and we're taking fees, stock options in lieu of fees. I'm 24, don't know that much. And then it was like somebody turned off the spigot. And I often tell the story, right? I went from making several $100,000 a year to $50,000, and my little girl had just been recently born. We just bought a single family house, and I just remember it was like the faucet got cut off. Now, luckily enough, we were good. We were able to remargin our life. We were able to figure it out, right? We were able to weather that storm as a business, and we built that business back up in 2005 when I had my business partner essentially buy me out of the business because I was buying real estate, and during that time, real estate was going up, right? Like the year 2000, 2001, 2002. So what had happened was I had started moving some of the money I was making from the recruiting business. And yes, I invested some of it in stock, which all went to some of it went to zero, which I learned a valuable lesson. Like, don't invest in any one stock, right? Diversify through the S&P, especially for somebody like me that doesn't play that game all the time. But we were also buying real estate, and that real estate was now appreciating in value. And if I needed cash, I could liquidate one of the assets. And so anyhow, I fell in love with real estate. But the summer of 2005, it felt like irrational exuberance all over again in the game of real estate. And I turned to my wife and I said, I think I want to go into this business full time. The issue is more than likely it's going to hit some massive downturn. But if we can survive that, we keep our expenses low, and we'll be positioned really well. And when the market is, in a trough. And that's what happened in 2008. We just started buying assets along with a partner because everything was 50 cents on the dollar, right? So I look back and I was like, wow, still young and dumb, but I went against the grain because I heard something, and this is what reminded me of this. I think Warren Buffett said, when everybody's fearful, be greedy.
Yeah,
And when everybody's greedy, be fearful.
exactly.
And I just remember, I'm like, everybody is in extreme fear.
Right.
Like, we need to be a little greedy when everybody's in extreme fear. And my floor were rents. I was like, the rent to purchase ratio now made sense again. That was my floor. I was like, I don't see rents going lower, right? That was my floor. And so very crude analysis on my part, but it worked out. I'm even scared to ask you this question right now.
Go ahead.
Right? I was like, there is crypto winter happening right now.
Yes.
I don't get the sense that you are a crypto person, Earl,
No,
but maybe,
no.
right? Okay. So Bitcoin right now is at,
Yeah.
I don't know, hovering in
66,000,
yeah,
something like that.
65, 66, down
Yeah.
from 127, right?
Yeah.
I suspect you probably tell your clients to stay away from
Yes.
that altogether. Right?
Yes. Yeah. Actually, one of my clients 6 months ago asked me, Earl, should I sell my crypto? I said, 100% sell it all. um, I don't think he listened. So unfortunately, but I myself through Kalshi, I've been making bets against crypto, and those have been good money makers for me. So with crypto, the problem with crypto is that it is subject to supply and demand, and supply and demand is for crypto specifically is more volatile than gold or a painting, because at least with gold, there is some real use to it. There's jewelry and other industrial uses for it. Silver, same thing. With painting, at least you can hang it on your wall and look at it, appreciate it. Other people will for sure want to buy a Picasso at some level, right? So you have a floor. With Bitcoin, there is no hypothetical floor. And that's the problem. And so you're subject to emotions, and it's really gambling. And if you want to gamble, go ahead, but it's not something that I would recommend.
Yeah. No, I got that sense. And if you are in it and you're listening to this, long-term horizon and maybe 1% of your portfolio, something.
Yeah, that's fine. Yeah, you can.
Okay.
You're allowed to gamble with a small portion of your portfolio. That's definitely okay. But there's also this other. You asked me earlier, what are some of the common mistakes that investors make? So one of the things that people make a mistake on is that they want to make up their losses in the same way how they lost the money. So in other words, if you lost on Bitcoin, right? They want to make the money back on Bitcoin. But you know what? You don't have to. You can make it back on real estate. You can make it back on stocks. You can make it back through a different vehicle or investment.
That's so cool. I've never heard actually anybody say, I can see that, right? I can see that happening. You can make it back on another investment. I can see people getting stuck.
Yes.
And it's almost like they want to be proven right.
Right.
They want to be proven right. When at the end of the day, it's math, and let's worry about the rate of return on the overall portfolio, the overall business. It's one of the things that I love about just real estate in general, especially holding long-term assets. So October of last year, we knew we had this big purchase. My wife and I wanted to buy this river lot property, and I know the market really well. It's very rare. I've been looking for 6 years, and I haven't found an equivalent like property. 7 acres cleared all the way to the water with a house on it, sub $1 million. I had not seen it. And I found it, right? And it was never on the market, right? It was an owner that had sold me another piece of property before. And so I had some crypto, and this was October of last year. And I said, I know what the value is right now. And even though I don't need to buy this piece of real estate for another 5 to 6 months, I'm worried about what the beginning of the year is going to look like because you just don't know. I know what if I liquidate right now, I know what I'm getting, and I could take that money and buy this particular piece of property. And boy, I am glad I did. Right?
Great timing.
Yeah, great timing. Great timing. And some of it's luck and all the rest. But I remember thinking one is ethereal, it's an idea, and the other one is very physical that I can experience, like a painting, right? Like I can experience walking out onto the 7 acres and looking at it. And so it feels very real to me, which I know this will be valuable to somebody else, right? In that respect. So, I have yet, if you talk to somebody like Jack Mahler, they're all in, right? Michael Saylor, all in on Bitcoin. And I'm like, man, they are betting the farm on this.
And we've seen time and time again throughout history that people who bet the farm, a good chunk of them usually bust, right? There are a few that will survive, but most of them bust. So there was this story of long-term capital management in the late 90s. So in the late 90s, a firm called Long-Term Capital Management was founded by the best and brightest of Wall Street. You even had 2 Nobel Prize winners who were part of that group who founded the company. And they were making money every single month, nonstop, like completely for 4 or 5 years. But then they got overconfident. This is one of the other mistakes that many investors make, is they got overconfident and then they bet the farm on this thing, and it didn't work out in their favor. They were right eventually, but in investing, if you are over leveraged, time is your enemy. You need to, that's why I was saying earlier, longer term horizon, helps you survive any kind of crisis. They needed to be right in a short period of time. And because of ego and just being right for several years, they bet the farm on this thing, and that one thing erased all their losses and then some.
All their gains.
All their gains, and then even more than what they lost. More. They erased all of it and more. And this is the best of and brightest of Wall Street, plus 2 Nobel Prize winners. So if they can be subject to overconfidence, anybody can.
Yeah, it's interesting. I think Charlie Munger was talking and referencing that. He said, the thing I've seen is when people just, how he's so direct, right? He's like, it's just plain stupidity when people bet, bet the farm on something, and they erase 30 years worth of work because they had no reason.
You don't need the money.
There's no need to do it.
Yeah, exactly.
It's like ego, right? It's so for those listening, like, take that in, because I think this idea that Earl and I are talking about right now can save you a lot of heartache. I've had friends of mine, very successful friends of mine, who got into real estate development projects that if the projects didn't go right, they'd be wiped out. So they never asked themselves, what happens if? What happens if all the projects take longer? What happens if something goes down, right? And so they're never calculating the downside of the deal. They're only looking at the upside, and they were wiped out, right? What happens if you can't get out? And so I think, Earl, that's helpful for us to kind of process and think through as real estate investors, right? All the same principles exist, and I think letting time. Can you survive a lack of liquidity is what I heard you say as well, which goes back to the concept of live 2 rungs or rings below, right, what you actually are making, which is a philosophy that my wife and I have always had. It's like, hey, as entrepreneurs, you just never know what next year is going to bring. And so let's just be comfortable. We don't need much, right?
I have 3 things to say about what you just said recently. So the first thing is that in terms of the investors, right, not paying attention to risk. So what people normally do that's wrong is when they make an investment, they look for people who agree with them. Yes, this property is, you're right, this is going to potentially make you a ton of money.
Confirmation
Or this stock.
bias.
Yeah, that's right. And what I actually do when I'm researching stocks, I look for the people who have the opposite view. So that's number one. Number two, instead of, you mentioned about saving stuff. And so this is another great saying from Dave Ramsey. So he likes to say, we buy things we don't need with the money we don't have to impress people we don't like, right? So it's like people can save so much money if they don't really care, if they just stop caring about trying to keep up with the Joneses and what their image is to other people. And as an example, my kids, one of the few things I splurge on, and I'm, again, quite frugal. One of the few things I splurge on is my kids' education, and they both go to private school. And one of the things that I do intentionally to make sure that they try to grow up grounded is that I drove like a 20+ year Honda Civic for a long time. When we go on vacation, nothing is Facebook share worthy, to put that in perspective, and we don't do it that often. So to keep them not feel entitled and feel like the same way as their classmates, I continue to live 2 levels below my means, and I'm not afraid to drive that Civic in front of the Bentleys and the Lamborghinis that the other parents have. I'm okay with it. It's kind of like my badge of honor. And to be honest, at first, the first year I was kind of like uneasy. I was kind of like parking far and stuff. but after the first year, it's like, you know what? It's a badge of honor. I can stomach looking like the poorest person in this room, and I'm okay with it.
It's funny because, man, I agree with you on so many levels. I remember a long time ago, somebody, I teach all these investment classes, and I had some watch on, right? And this gentleman walks up to me, and he says, well, if you were a millionaire, you'd have like a better watch, right? And it, what I had was, it was branded Casa. The watch was branded like my company name.
Oh,
right?
okay.
And I just remember thinking, well, like, I prefer to buy houses. Like, the watch for me, because I have friends that like are really into watches, right?
Yeah.
But for me, I'm like, I have no value in my mind for a watch. I can never fathom paying a lot of money for a watch. But for like my business partner loves Rolex watches. Like, that's his thing. Yeah. It's like he loves it. I'm like, yeah, it does nothing for me. Same thing with cars. They do nothing for me, right? Houses, a different different issue. Like, I like collecting houses. Yeah. I like collecting properties. But my wife and I, she badge of honor, she had 200,000 on her Toyota Highlander, right? Before she decided to sell it and buy another Highlander, right? And she's like, yeah, I just love these. I could drive them forever, right? Somewhere we all have these things that we pick up when we're younger, because I really do believe that they're planted when we're younger, that it was, a badge of honor for me not to wear. Like, I went and bought a watch the other day. We were in Las Vegas. It was a Swatch watch, right? Because when I was younger, I had a Swatch watch. And so we call it a Swolex. Oh, Rob bought a Swolex for $136, right? But it's cool. It's red. I don't know where it is. I didn't put it on this morning. But, but there are other things that I spend a lot of money on. Same thing. I paid a lot of money for our daughter's private school. I was like, that's something that can't be taken away from her, like the knowledge, the relationships, all the rest. So I put a lot of value in that. All of us have these different degrees of things that we put value in, right? Yeah. And we all, I think, have to be aware of what those things are.
Yeah.
Right. Money is emotional. Money is such an emotional thing. It's emotional.
Yeah.
Well, Earl, if somebody wanted to find you, what's the best way that they could reach you?
Yes, they can. I created a specific web page for your audience. And it's mywealtharch.com/grid. So I'll just spell that really quick. mywealtharch.com/grid. And in that specific page, your listeners can subscribe to a free 30-day investment update that I provide. Additionally, they can contact me for any questions or want to schedule a meeting. So yeah, check us out there.
Earl, thank you so much for sharing time with us on the Income Flip podcast. I appreciate you.
Thank you, Rob. It's been a pleasure.
Okay, so what we're going to do, media team, I'm going to do a new intro for Earl. I'm going to get his name right this time, right? And I'm going to need you guys to go back and edit because we had some, I don't know what happened to the camera, but we'll figure it out. So Earl, just make sure I'm getting it right. Yaokasin.
Yes.
Okay.
Yes.
Okay, so let me, Yaokasin.
Yes.
Start this up.
You
Okay.
got that.
Okay, today on the Income Flip podcast, I have Earl Yaokasin from Pasadena, California. Earl, thank you so much for joining us on the Income Flip podcast.
Thank you, Rob.
Cool. Well, let's get into this. Cut. There we go.
All right.
Okay. Earl, thank you. I have to run to a 3 o'clock. I'm going to be late, but I am so sorry. Like, I have no idea
worries.
what's happening with
No
my
problem.
main camera, right? And I love, by the way, I love your investment philosophy. Like, I can sense your heart for really helping your clients in your community, especially when you're just kind of investing alongside. I'm very Warren Buffett of you, by the way.
Yeah, thank
Right.
you. Thank you, Rob. This conversation has been fantastic, and you're one of the better hosts that I've been on for podcasts, and I already gave you a 5-star rating on Apple Podcasts. Also subscribe on YouTube as well. So thank you. If you're ever in Pasadena, let me know. I'd love to take you out to lunch.
Yeah, I might connect you with my leader out there. Just who knows where that connection will go. So
Sure,
I
of
appreciate it,
course.
Earl. Thank you
Yeah.
so much.
Okay, take care, Rob.
Take care. Bye.
Take care. Bye.